Gold dropped to 4 at 262 about $50. That is a 4-month low. Down 8% at its worst point in a single session. Down 15% since February 28th. $7.9 billion worth of gold, 54.8 tons, left ETFs this month. And then one statement from President Trump. And gold bounced, stocks jumped, the dollar slid. Silver went from losses to gains of 3.3%, 3 markets, 3 reversals. One statement. That does not happen when markets are functioning normally. That is the behavior of a market so tightly wound around a single variable that one piece of news, not data, not a Fed decision, not an earnings report, one political statement can flip the direction of multiple asset classes simultaneously. The statement was a delay. Trump announced he was postponing strikes on Iranian power plants and energy infrastructure, not canceling, not ending the conflict, just delaying one specific category of strike. And that was enough. But here is what is worth understanding before you interpret that bounce as a signal. Because the bounce is real, and the reasons underneath it are more complicated than the headlines are suggesting. Let's lay out exactly where everything landed, because the range of prices in today's session is extraordinary. Gold hit 4 at 262 pound 50 at its intraday low. Gold closed around 4,388 to 4,431, depending on the source. That is a range of roughly $170 within a single trading day. Silver hit yearly lows, then recovered to close at $68 to $70 with gains between 0.6 and 3.3%, depending on the session timing. The dollar index held near 99.50, then softened after the Trump statement, then reasserted as safe haven demand returned on the lingering Iran uncertainty. Stocks jumped, all of that in one session. The reason the range matters is not the prices themselves. It is what the range tells you about the state of the market. A market that swings $170 in gold within a single session is not making considered fundamental assessments. It is reacting. It is responding to headlines in real time. And when markets react to headlines rather than fundamentals, the moves tend to be fast, violent, and partially self-correcting. Which means the bounce from 4,262 to 4,131 is not necessarily the beginning of a recovery. It might simply be the headline premium being partially restored. We need to separate those two things. Here's the question that most of today's coverage is not asking. If gold bounced because Trump delayed the strikes, because the delay reduces immediate inflation fears from an energy infrastructure attack, then what happens when the delay ends? Trump did not cancel the strikes. He postponed them. The Iranian power plants and energy infrastructure are still potential targets. The conflict is still active. The inflation risk from an energy infrastructure strike did not disappear. It was deferred. So the bounce today is pricing a temporary reduction in one specific tail risk, not the resolution of the underlying situation. And that distinction matters enormously for how you should think about gold's current level. We will come back to that. But first, there is something in the ETF data that deserves specific attention. Because 54.8 tons of gold leaving ETFs this month is not a footnote. It is a signal about what institutional money is actually doing versus what it is saying. $7.9 billion. 54.8 tons. Those are the ETF outflow numbers for the month. Let's put that in context. ETF outflows at that scale mean institutional investors, the funds, the asset managers, the pension accounts that access gold through paper instruments rather than physical bars, have been reducing their gold exposure throughout this period. Not the retail investor buying coins. The institutional layer that moves in and out of gold through exchange-traded vehicles. When institutional ETF outflows reach $7.9 billion in a month, it tells you something important. It tells you that the people who manage large pools of capital have been using gold's elevated prices, the war premium that pushed gold to record highs earlier in this conflict cycle, to reduce their exposure. They were sellers into the rally, and they have continued selling through the decline. That is not the behavior of institutions that are bullish on gold's near-term trajectory. That is the behavior of institutions that are taking profits on positions built at lower levels, or reducing risk exposure in a volatile environment, or rebalancing portfolios that have become overweight gold after months of price appreciation. Now, here's the unusual part. After 54.8 tons of institutional selling through the month, the price bounced today on one Trump statement. Who was buying? Because if the institutions were still selling into 4,262, the buyers at that level were someone else, bargain hunters. Retail investors who saw a 4-month low and decided the risk-reward was favorable. Traders covering short positions. Algorithmic systems triggering at technical levels. That kind of buying, tactical short-term, not driven by a fundamental change in the thesis, produces bounces, but it does not necessarily produce sustained recoveries. The dollar index held near 99.50. That number is getting less attention than the gold bounce or the stock rally, but it is the most structurally significant data point in today's story. Here is why. Gold's recovery from 4,262 to 4,431 happened partly because the dollar softened after the Trump statement. When the dollar softens, gold gets mechanical lift because it becomes cheaper for foreign buyers. That is the straightforward channel. But the dollar did not collapse. It softened and then reasserted near 99.50 as safe haven demand returned on lingering Iran uncertainty. The DXY at 99.50 is elevated. It has been elevated throughout this conflict cycle. And an elevated dollar is a persistent structural headwind for gold that does not go away because of a single session bounce. Think about what 99.50 on the DXY represents in the current environment. It represents a market that still believes the Federal Reserve is going to be forced into tighter policy. It represents continued demand for dollar-denominated safe assets because the geopolitical situation has not resolved. It represents the rate hike pricing that erased every cut bet for 2026, which we covered in the previous video, still being partially embedded in the currency. A dollar at 99.50, while gold is at 4,388, is not a comfortable combination for gold bulls, because every dollar of gold's recovery from today's lows is being achieved against a currency headwind that is not giving ground. And here is where the bigger picture gets interesting. Gold is down 15% since February 28th. That is the date before the US-Israel strikes on Iran began, which means gold, measured from the start of the conflict, has not been a safe haven. It has been a losing position. The war that was supposed to be the strongest possible argument for owning gold has produced a 15% decline from the day before it started. How is that possible? We have covered the mechanism across this series. The war created oil-driven inflation. Oil-driven inflation created a hawkish Fed. A hawkish Fed created rate hike pricing. Rate hike pricing created dollar strength. Dollar strength created a structural headwind for gold. And the headwind was stronger than the safe haven tailwind. But here's the question that today's bounce raises. If one statement from Trump about delaying strikes can produce a bounce from 4,262 to 4,431 in a single session, what does that tell you about where the price floor actually is? Is 4,262 the bottom? Or was it a liquidity-driven overshoot that snapped back mechanically? And if the conflict eventually moves toward a genuine resolution, not a delay, an actual ceasefire or diplomatic framework, how much of the war premium that was priced in at the highs gets released versus how much of the yield and dollar headwind also goes away? That calculation does not have a clean answer. But it is the right question to be asking right now. Silver going from losses to gains of 3.3%, closing near $68 to $70 on the same day it hit yearly lows deserves specific attention. Because silver's behavior today is more extreme than gold's, and the reason it is more extreme tells you something about the different forces operating on the two metals right now. Silver, as we have covered throughout this series, has both a monetary component and an industrial component. The monetary component responds to the same forces as gold: Fed policy, dollar strength, safe haven demand. The industrial component responds to economic growth expectations and manufacturing activity. When Trump delayed the strikes on Iranian energy infrastructure, the market priced a reduction in near-term supply shock risk. Less supply shock risk means less oil-driven inflation. Less oil-driven inflation means slightly less pressure on the Fed to hike aggressively. Less aggressive Fed means slightly lower yield expectations, and slightly lower yield expectations benefit silver's monetary component. At the same time, reduced energy infrastructure strike risk means slightly better global economic growth prospects. Better growth prospects benefit silver's industrial component, so silver got a lift on both its monetary and industrial dimensions simultaneously from the same Trump statement. That double lift is why silver moved more aggressively than gold on the news. Gold only has the monetary channel. Silver has both. But here is the caution. Both of those channels were activated by a delay, not a resolution. The same logic that says silver bounced on the delay says silver faces renewed pressure if and when the strikes resume. Let's step back from today's specific moves and look at where we are in the broader sequence. Gold peaked during the early phases of this conflict cycle when the war premium was being applied and the full inflation consequences had not yet been priced. Then the inflation consequences arrived. The Fed turned hawkish, rate hike bets replaced cut bets, the dollar strengthened to 99.50, and gold declined 15% from the pre-war level. Today's bounce from 4,262 to 4,288 represents a partial recovery within that decline, not a reversal of the decline, not a return to the war premium highs, a partial recovery from an intraday overshoot to the downside. The 54.8 tons of ETF outflows are still sitting as evidence of institutional positioning. The dollar is still near 99.50. The rate hike bets are still partially priced. The conflict is still active. And the strikes on Iranian energy infrastructure are delayed, not canceled. In that context, the bounce is real, but it is bounded. The ceiling on gold's recovery is the combination of dollar strength, yield pressure, and institutional selling that has been in place throughout this cycle. That ceiling has not moved because Trump delayed some strikes. What has moved is the floor. The intraday low of 4,262 established a reference point. Whether that becomes a meaningful support level or whether it gets tested again depends on whether the delay holds and whether any of the macro headwinds begin to ease. Here is the uncomfortable question that nobody is asking cleanly today. The delay in strikes on Iranian energy infrastructure reduced immediate inflation fears. That is why gold bounced and stocks jumped. But the delay also means the conflict continues without a decisive escalation. A conflict that continues without resolution keeps the uncertainty elevated. Elevated uncertainty keeps safe haven demand alive in a low-level way. But it also keeps the oil supply disruption risk alive. And it keeps the inflationary pressure from the existing disruptions, the Ras Tanura refinery, the Qatar LNG halt, the Strait of Hormuz situation, in place. None of those resolved because Trump delayed some strikes. So the delay produced a market reaction that reduced inflation fears on the one hand, while leaving the existing inflationary pressures from the ongoing conflict completely unchanged. Is that reaction rational? Or is the market responding to the headline of the delay without fully processing that the underlying inflationary situation has not changed? That question does not have an answer today, but it will have an answer when the next inflation data arrives. And if that data shows that the existing supply disruptions are still feeding through into prices, regardless of whether the energy infrastructure strikes happened, the market may discover that the bounce was built on a premise that the data does not support. A $170 intraday range in gold. Silver going from yearly lows to gains of 3.3% in the same session. Stocks jumping on a political statement. The dollar strengthening, then softening, then reasserting. All of that volatility is not just noise, it is information. It is telling you that the market has not found a stable equilibrium for gold or silver in the current environment. Every data point, every political statement, every Fed comment is producing outsized moves because the underlying uncertainty is so large that the market cannot confidently anchor to a fair value. When markets cannot anchor to fair value, they become headline-driven. And headline-driven markets are dangerous for investors with strong directional views, because a headline-driven market can move sharply against any position, long or short, on information that has nothing to do with the fundamental case for that position. Gold at 4,262 was not a fundamental assessment. Gold at 4,431 later the same day was not a fundamental assessment either. They are both products of a market under extreme stress trying to reprice rapidly in response to an environment it cannot fully model. The investors who got hurt today were the ones who had leveraged positions and could not survive the move to 4,162 before the bounce to 4,431. The investors who benefited were the ones who either had no leverage and could hold through the volatility, or who were tactical enough to buy the overshoot. Neither of those is a story about gold's fundamental value. Both of them are stories about how to navigate a market that has temporarily lost its anchor. Gold hit 4,262.50 today, then recovered to 4,388 to 4,131. Silver hit yearly lows, then posted gains of 3.3%. Trump delayed strikes on Iranian energy infrastructure, and three markets reversed direction simultaneously. The dollar held near 99.50, 54.8 tons of gold left ETFs this month, and the conflict is ongoing. None of that adds up to a clean conclusion. The bounce is real, but the conditions that produced the decline are also still real. Dollar near 99.50, rate hike still partially priced, institutional selling through ETFs, conflict active, existing supply disruptions unresolved. What changed today is that one specific escalation risk, strikes on Iranian energy infrastructure, was delayed. What did not change is the broader inflationary environment that those disruptions have already created. The next test for gold is whether the delayed strikes stay delayed, and whether the existing inflation from the conflict's earlier phases starts showing up in data that the Fed will have to respond to. If the delay holds and the inflation data softens, the floor at 4,262 may prove durable and gold builds from here. If the delay ends and the energy infrastructure gets hit, or if the inflation data comes in hot because the existing disruptions were enough, the bounce from today gets tested again. Gold at 4,388 is not an answer. It is a question. And the answer depends on things that have not happened yet.